Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin this hour with stocks hovering near fresh records on the S&P 500. CIO Group CEO David Bailin joined us now for more. David, good morning.
Good morning. Pleasure to be here.
Congratulations on the new seat, and we can talk about what the company's going to be doing in the not-too-distant future, but I want to take the temperature of this market with you. What are your thoughts about where we are, where we have been, and where we're going?
Yeah, I mean, it's pretty obvious that you've got a momentum on situation. You've got an earnings growth situation, earnings broadening situation. I think there are areas of the market where you're seeing even more of that. Internationally, 70% of international markets last year outperformed the U.S. U.S. investors virtually unexposed to those markets, right? Lack of diversification in their portfolio. So I like the momentum of the market. I like where it's going, but I think there are lots of areas where people need to go, whether it's in pharmaceuticals, whether it's in energy, whether it's in MLPs, where there's simply no real action on the part of investors. It's all about tech, all about big deals all the time. And I think, I think the good news is we believe that will continue, but we also think that it indicates a growing risk in portfolios.
Well, let's go to the international story. So I'm with you, and we've seen that spread to Asia in a bigger way to start the year. Is it just a different flavour of the same story, though? Just tech, but tech elsewhere?
Yeah, in part that's true, but remember that it's really an earnings story, right? It's where you're going to see, lower valuations and higher growth rates internationally, right? And you can see that in Japan, you can see that in India, right? And you can see it even in pockets of Europe and in Germany, right? As a result of the changes of the geopolitics. So you could play all of those things, but if you're an investor, you want to own that growth at a price if you can, and you can't find it at a cheap price in America anymore at all.
Just to take what you're saying a step further, are you saying that anyone who invests completely in the U.S. or more heavily in the U.S. is exposed to a concentration risk that is historic and potentially really problematic?
That is the number one thing that we're talking with clients about today, is the fact that if a client has multiple advisors, right, and they're all investing on the same thing and they don't rebalance portfolios, and that is the number one observation that we've seen in our data this past year, is that everyone is letting these trades ride. So you have one of the riskiest stock sectors, right, semiconductors, large company, right, NVIDIA, right, leading the stock market, and it is in a highly volatile marketplace. And so we don't think there's a problem this year, fair enough. But the question is, if a person's got, that type of concentration risk, where should they move that money and when, right? And that is a 2026 move as far as we're concerned.
So you think it's international? Is it international equities? Is it in the commodity space? Where exactly do you see actual diversification against something that's really global?
Right, so you can actually do that through dividend shares in Europe in specific sectors, right? You can do it in pharmaceuticals here in the U.S. and internationally. You could do it in tech in Asia in certain areas, right, in terms of where AI is going to influence consumer markets and consumer brands. So there's lots of places where you get the growth story, but you also get diversification as to industry. Everything that we're doing is focused on where earnings are going in those places. So it's lower valuations, higher earnings growth rates, non-U.S. We're now about 20% non-U.S. in terms of our portfolios, which we can do because we're not limited to where we were when I was working in a large bank.
You also say treat cash as an asset class.
Yes.
How much should people be allocating?
So two facts that I don't think people know. The average family, right, has more than 9% of their portfolio in cash and has had it there for basically 5 to 10 years, saying they'll be opportunistic, and they never are. The average cash yield for that family is 2.7%. They could be earning 4% in treasuries. They could be earning 5% if they have a blended portfolio. And one of the reasons why that's true is that they have their cash in 15 different accounts. None of it's aggregated and it's not managed. So why is that the case? It's largely because there's a little bit everywhere. And so that's an enormous opportunity. If you have 9% of your portfolio and you can make an extra 150 basis points in it, right, you should be doing that. And these are the observations that we're now able to see, because when you look across all of the accounts that a family has, you can actually just see how it is that they are really undermanaging certain assets. And that's why we call cash as an asset class, because it's a large portion of the portfolio and it's largely undermanaged.
You're laying the foundations for a broader conversation about what you're doing now. How much extra insight do you have now versus what you had previously? And would you go as far as saying that this industry is letting some of those families down?
I would actually go far as to say that I really didn't think that a year ago, right? But it's not only, it's a structural issue, because if they can't see the assets, theoretically they can't comment on them. But what's really interesting to me is that the industry is charging an enormous amount in fees for the advice that they get. So the average family is probably paying 1.4% if you add up the cost of the funds they own and the cost of their advice, right? Which in a 15% year is 9% of what they actually made, right? And yet, right, they're basically index oriented. They're getting all of this exposure without getting diversification, and they're getting, not very good yields on their cash. So I would just say that they're not getting the implementation of the advice that they should about following the basic rules of finance, which is diversification and meaning it. And that's what I would say. Yes, that's true.
At a time when there's so much focus on wealth management at big banks, why do you think this is? Is it just groupthink, or is it that there are certain incentives to be invested in certain areas?
I just simply think that the industry is going under such an amount of consolidation right now. RIA roll-ups, banks basically buying other, wealth management institutions, consolidation in asset management. It's an extremely profitable time for the industry, right? So there's no real reason to take a look at the very nature of its fee structure, given all of that, right? If you think about it, right, clients can get. I'll give you an example. If you take our asset allocation and you actually look at the cost of the funds that we use, it's 18 basis points to actually buy all of the ETFs in the United States that we like, with extraordinary specificity as to what individual sectors you want to get exposure to. If you want to get exposure to ETFs in MLPs right now, which we're doing, or in pharma, right, or in biotechnology, you can literally buy those at very inexpensive things. So you can assemble a portfolio that way, or you can pay for active management at 60 or 70 basis points and not get any benefit from it, right? Well, the industry is largely stuck on the way that it's done it. It has no incentive to change.
David, just before you go, is there a wealth bracket in particular that you think is vulnerable to some of the issues you just explained?
Yes, it's a very wide bracket. But if a family has, $10 to $500 million, and they're using multiple advisors, which is a huge amount of wealth and extraordinary, right? But if they've got $10 to $500 million, right, and they're using multiple advisors, the probability that they're beating the markets or that they actually have their money adequately and diversified and invested is extremely low.
What happens 500 and up?
They tend to get more advice by having an individual inside the family who is actually coordinating the professional activities. And interesting is they actually have goals and an IPS that they're following and are being checked on. It's when they don't have that and they're relying on multiple providers that they end up not having a sense of direction.
Stay with us. More Bloomberg surveillance coming up after this. John Bilton of JP Morgan Asset Management writing, given our expectation of a moderate pickup in the pace of growth in 26, we see potential for positive equity returns. John joins us now for more. John, good morning.
Good morning.
It's good to see you. We've been flattered. We've been blessed by some really, really decent double-digit gains on the S&P 500. Is there more to come?
Well, I think if you believe that the economy is in a decent place, you believe we're going to get fiscal stimulus coming through this year, we see unemployment, behaving itself per your earlier comments just now, if we see the impact, which is always delayed, of the Fed cuts coming through and actually supporting the economy, which we think they will, then if you look back through history, 9 times out of 10 in a year with no recession, and we're not calling for a recession, we think the odds are pretty low, then the S&P delivers positive total returns. So sure, if you want to bet against stocks, go crazy, but the odds are not your way.
Skate to where the puck is going. Where do I want to be now, already, to take advantage of some of this?
Well, we think that what we're going to be seeing this year is, a little bit more in terms of the continuation from some of the themes last year. Things like that gradual weakening of the dollar, which is going to flatter some of the international markets. Of course, if we look at what happened with Europe, with the US, the indices in terms of their returns in local currency were not too dissimilar. But you got a big boost as a US dollar investor if you were beginning to be a bit more adventurous and look outside. We've obviously got that AI trade, which continues. We think it's important in the US, but remember, it's a concentrated piece of the market. People want to be able to find a different way to invest. Asia looks pretty good there. Some of the impact in terms of the investments that have been made in the last few years start to bear fruit. Does it broaden out across the economy? I think that's the sort of themes that folks are looking for this year, trying to put a few more eggs in a few different baskets.
I was going to ask, how adventurous do you want to get? Samsung or Venezuela bonds?
I think we... well, there's a few themes there, aren't there? I mean, one of the other things which I think is supportive of the economy generally is this emphasis on oil prices coming down, right? So anything which is freeing up supply, potentially being a bit of a sort of downward pressure on oil prices, ultimately is good for the consumer. That's ultimately good in the US. It's supportive globally as well, of course, but that's going to be something which matters a great deal. Just having another year of the economy being a global, a going concern globally, I think that's really important for confidence, which in the US, if we look at consumer confidence, it's been hit pretty hard. Actually, if we look at where the stock market is versus where consumer sentiment is, there's a big dichotomy there, and it's even worse in Europe.
It's really a difficult narrative to get my head around. Pretty much the entirety of this year is going to be a difficult thing to get my head around. But I'm wondering, people say the commodity costs are going down because oil prices are going down. And then we look at copper, then we look at lithium, then we look at some of the other inputs at all-time highs, continuing to skyrocket, at gold and silver, et cetera. So some of the other inputs that we're going to be using increasingly, electricity costs. So how do you square this idea of the disinflation from oil prices and, frankly, the inflation from the rest of the commodity sector, which a lot of people are betting will continue?
Well, I think you put it into the chain it works in. The push-up in commodities prices is a symptom of the investment that's being made. And the investments that are being made at the moment are in building productive capacity. It's in electrification, which will ultimately bring down costs. It's also in data centers, which is a huge part of the AI sort of infrastructure build-out. We're going through a massive building phase at the moment, a phase where we're building productive capacity, and we know that the biggest driver of total factor productivity over the long run is the investment made in those productive assets. That's what we're seeing today. Yes, of course, there's going to be tightness in places. I mean, the swing demand today for copper is not China as it always was for many, many years. It's much more what's going on in terms of electric vehicles. It's what's going on in terms of data centers. So it's a symptom, I believe, of a bigger theme, which is this big investment phase that we're seeing right now.
You say that you're becoming more constructive on Europe, specifically Germany, this made in Germany. How is that possible when China has been decimating their industrial base?
Well, I think we've got a few things. I mean, this is not new news. Chinese competition in Europe has been a big deal for the European Union for some time. There's been a lot of talk about concerns over product dumping, that sort of thing. But what's been happening beneath the surface is that you've gone through a couple of years of German industrial production really being on its knees. Very little inward investment, very little infrastructure investment. And really what we saw last year was the opening up of the fiscal taps, very rapidly followed by opening up of capex taps. Now, European savings rates for households currently sit at 15.3%. That's the highest level outside of the pandemic. You've got the biggest consumer bloc in the world not spending. This year, we've got incomes now rising above the pace of inflation. Start to turn that back on. And I'm not suggesting European consumers suddenly become US consumer-like, but just at the margin, that can give a big boost. And although the PMIs earlier this week were a little bit softer than expected, they're still coming in line with a 1.6% GDP growth rate, which is, half as much again as the growth rate in the first half of last year.
Do you think the German fiscal impulse translates to the rest of continental Europe?
Not necessarily, because this is the issue with Europe, or what holds it back in many regards, is not everyone has the same fiscal space. But make no mistake, I mean, Germany still remained the biggest bloc within Eurozone, and it really is the heartland of industrial production within the Eurozone. So really sort of getting that piece right to sit alongside some of the strength we've seen in Spain, other parts of the periphery, and offset some of the concerns in France, that's a big deal in terms of taking it from a continent that many folks had forgotten that still managed to do, in dollar terms, 30% on its equity index last year. And all of a sudden, it can come out and surprise people.
John, can we finish on a simple but I think highly consequential question, which is, what are the indicators I should track this year and what should I ignore? We've got ADP in about 6 minutes' time. We've got payrolls on Friday. If I tracked those and just said, you know what, based on that data point, I'm going to be long or short this equity market, I'd have got things very wrong in the last 12 months. What should I ignore? What should I pay attention to?
Well, I think, if only there was one indicator we could all watch. I mean, but then frankly, I'd be out of a job. So,
got to be a little careful. Going to help you more?
What I think matters most of all is the fundamentals. It's what are companies doing? Are they able to translate this massive investment flow into earnings? Remember, with the labour market, we've gone through a seismic change last year. We've gone from a huge oversupply, a lot of excess capacity coming into the labour market. That's now gone. So we've gone through that sort of right sizing, if you like, of the labour market. It's a much lower level of payrolls needed to keep track with trend GDP growth. It's in the 50 to 60,000 range, not in the 200,000 range as it was. So you're talking smaller numbers. But at the end of the day, America's superpower is its corporate sector. If its corporate sector is building profits and it's creating a positive return on the massive investment that's coming through, then that's a reason to be constructive.
Stay with us. More Bloomberg surveillance coming up after this. So here's the latest this morning. President Donald Trump pushing House Republicans to own the healthcare issue ahead of the midterms as voters show they are more concerned with affordability than foreign affairs. Jonathan Tamari of Bloomberg Government joins us now from Washington for more. Jonathan, that's at the top of the agenda for Americans in this country. How are they going to speak to that? What are they going to do in the year ahead?
That's the really big question. One of the challenges for Republicans is that they haven't laid out a clear affordability agenda. You know, the president is talking about trying to lower gas prices. He's made this kind of targeted pitch on health care, but these things are going to be really hard to happen quickly. Right now, there are millions of Americans who are paying higher premiums through the Affordable Care Act because some subsidies expired under Republicans' watch this past year. And so it's a major challenge, and they have a very narrow majority in the House, so it's going to be hard to get any major legislation passed this year.
Jonathan, we talked about the pitch that's going to come from Republicans. It's going to be the tax refund, and hopefully the economy picks up going into the middle of the year. What's the pitch from the Democrats? What are they offering up going into midterms?
So they've yet to lay out their own affirmative agenda, which is a big challenge for them. It's something they've really struggled with during the Trump years. Right now, they're basically saying Trump promised you that he was going to lower prices, lower inflation, and that his focus has been elsewhere, that his focus has been on Venezuela, on immigration, on all these other things, and not on lowering prices the way he promised. As far as an affirmative Democratic agenda, we're still honestly waiting for that outside of the healthcare space.
Jonathan Tamari down in Washington. Jonathan, thank you. Appreciate you making some time for us this morning to build on this conversation. Henrietta Treyz of Veda Partners joins us now for more. Henrietta, Happy New Year and a welcome to the programme, a warm welcome. What's at the top of the agenda, do you think, for Republicans? What's achievable in the months ahead?
Well, with a one-seat majority, you have almost nothing that's achievable, and that's the state of play for Speaker Johnson right now. So when President Trump spoke to the conference yesterday, he laid out a whole host of things that Republicans would like to see. But the bottom line is this is where an understanding and being, a legislative wonk is really helpful. You just don't have the votes. So talking about reorganizing healthcare is not an option. The best that they could do is extend the ACA subsidies that expired at the end of the last year. 24 million people, some people paying $1,000 more in ACA subsidies. That's going to be the bulk of it. And the real news from that event yesterday was around the Hyde Amendment, which is related to abortion. We're on the same old issues we've been focused on for 16 years. So expecting radical change on the healthcare front is just unrealistic.
Henry, is there appetite within the Republican conference to expand those healthcare subsidies?
I think there's appetite to extend, definitely not to expand. So they put, wage requirements on there, duration requirements on there. It wouldn't be open-ended. The duration is anywhere between 6 months to 3 years. There's even a 5-year bill, but expansion is not on the table. And so that's sort of the best that they can hope for going into this.
So does this mean we will not have a government shutdown at the end of the month?
I don't think we're going to shut it down. I think Democrats feel like they proved their point. They got the narrative in the United States around the voting demographics to focus on affordability. And as y'all were just pointing out, they don't need a proactive agenda in their view. They just have to keep the conversation on affordability and housing in particular. And so that's where Schumer and Hakeem Jeffries are going to focus the narrative as they go out into the campaign trail. And, obviously the president is very concerned, as he has been throughout all of last year, with maintaining control of the House. But now even the Senate is slightly at play for the Democratic conference. And that issue of affordability is paramount, as you were just pointing out.
Well, the president yesterday said this, quote, "I wish you could explain to me what the hell's going on with the mind of the public." Henrietta, when it comes to the president and his pitch to the American people, when it comes to affordability, he has gotten gas prices lower, but grocery prices are higher. He has stopped the inflow of immigration at the border, something he pitched to the American people. But at the same time, right now, he's taking a very aggressive foreign policy posture. Is this something Americans want to sign up for when it comes to the midterm elections?
Such an exceptional statement to seize on. The president's commentary shows that there is, honestly, kind of gaslighting going on within the White House. And I would start with the tariffs. The tariffs are widely understood by the American public. Everybody watched the news on Liberation Day, and every small business that's importing anything, whether it's a children's toy or a refrigerator, is focused on what happens next. What happens at the Supreme Court? Do I need to pay this harmonized tariff schedule number? What's my tariff rate? Every single person in the United States is concerned about tariffs, and they do not like them. This is a rare example where Trump is at a 60-40, sometimes even 70-30 deficit with the American public. He likes the tariffs. America does not. And so when he says, what's going on, it's the tariffs. The foreign policy thing is actually very consistent with what we've seen from Americans for generations now. They just do not care. 4% of Americans think that the drug trade in Latin America is worth prioritizing. They just don't care. Bring the prices down. Nothing else matters.
Henrietta, what does that mean in terms of if the Supreme Court does strike down tariffs under the IEEPA Act, whether the president will be willing to go forward on a cocktail of additional tariffs and put them on, given that they are so unpopular?
There's a disparate view in D.C. If you are a trade policy person, you are looking at the tariff laws and the code and saying, what can I do? Can I migrate to a balance of payments authority and collect 15% tariffs for the next 150 days? Sure, you can totally do that. That is reasonable to physically do. But think about it from the perspective of the manufacturing base or any importer or business or American voter. You now have to go through Liberation Day all over again. You have to figure out what tariff schedule you're exposed to, what the rate's going to be, how long it's going to be there for, whether it will come back. If they use 338, that's never been used before in history. We're going to go through this whole rigmarole where it goes to the Court of International Trade, the Court of Appeals, and the Supreme Court all over again. So it's that uncertainty, which was the buzzword of all of 2025, that will come rushing back. And my view is the president has to take that into consideration, especially now that we're 11 months away from a midterm election cycle where Republicans are about to get shellacked with a D+4 generic ballot situation.
Henrietta, can we just finish on one thing, just take a step back? Why is everyone in Washington so bad at handling this issue? We torched the Biden administration, quite rightly, when they were talking about prices. Inflation was heading towards double digits, and they were like, there's nothing to see here, everything's fine, it's a great economy. It certainly wasn't for many people. Unfortunately for the president, he now owns the issue. He's the president of the United States, and the Republicans control Congress. They own the issue too. Why are we seeing successive governments perform so poorly on such a key issue for the American public?
I think the inflation memory bank is really strong. We're still in the mindset of the post-pandemic era. Is that sort of what the data suggests? I would point out the idea that you can't follow the University of Michigan Consumer Pricing Consumer Sentiment Index anymore. It's because now all of your views of the economy are shaped by your politics. So if you like Trump, you think the economy's great. If you don't like Trump, you don't like the economy. And now we have this mix-up between understanding your own personal finances, the state of the U.S. economy, and whether you like the person in charge. It's just a polarized United States economy, and it's seeped into everything.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.